Well, good morning, everyone, and a warm welcome to all of our clients and guests that are joining us today for another one of our Fund Manager webinars. And I think most of you would know me, but for those of you that don't, my name is James Malauris, and I'm one of the 5 financial advisors with GFM Wealth. This is probably the second time that I've hosted one of these webinars, so I'm looking forward to today. Today, we've got Nick Edgerton from Stewart Investors joining us to discuss the Worldwide Sustainability Fund. Nick is an investment analyst with Stewart Investors. The team manages funds in Asia Pacific, emerging market, worldwide and sustainable development equity investment strategies on behalf of clients. He joined the team in April 2012. Nick is responsible for generating investment ideas for the Sustainability Fund across all sectors in emerging and developed markets. Nick holds a Bachelor of Economics from Macquarie University and a Master of Science with distinction, well done Nick, in Ecological Economics from the University of Edinburgh. But before we bring in Nick to start the presentation, I can say that sustainable and responsible investing has been a very, very popular topic of conversation with our clients for quite a while now, given the current climate issues we are experiencing. Importantly, Stewart Investors has a very good track record in sustainable and responsible investing, being a certified member of the RIAA, which is the Responsible Investment Association of Australia, and just recently winning the 2022 Morningstar Australian Fund Manager of the Year in the Sustainable Investing category. So a really good feather in their cap for the strategy in the fund. So Nick, welcome to the webinar.
Thanks very much, James.
Joining us from Sydney.
That's right.
Stopped raining up there?
For today, at least. I think this is about day 3 this year.
Okay, very good. Well, they say the La Nina's finished, but they could come back again towards the later half of this year. So make sure you buy an umbrella and another raincoat or something.
Yeah, I know.
Well, at least the winter's sort of getting a bit easier. You know, we passed through the winter solstice yesterday, so the shortest day of the year. Thank God for that. And now we're on the way up. So look, thanks again for joining us, Nick. I really appreciate it.
Thank you. Now, can you see my screen?
Yes, I can.
Great.
So, Nick, just start a little bit of background about the fund. So if you could let us know and our clients know a little bit about when the fund started, the strategy and size of the fund, and most importantly, some of the members of the team that are spread around the world.
Yeah, sure. Thanks, James. And so you've got your GFM disclaimer here first, which I think says something like, this is general advice, and if you need any advice at all, please talk to you guys.
As always, thank you, Nick. Appreciate that.
We have a similar one that basically says the same thing, I think, which is this is general advice. So again, please speak to James about anything. So just moving on to the team, we're actually quite geographically diversified or moved around. We're 4 offices. We're actually a small team, 14 people. We're all generalist focused, so absolutely got respect for those people who want to find one issue and go very deep about it. But we're a team of generalists who cover a whole range of countries and sectors and different economies. And there's obviously very different strengths and weaknesses with that approach. So we've got a group of very keen and interested, what we like to call ferrets, people who like just digging away at company ideas constantly, and a real interesting mix. Pretty much everyone in the team has lived or worked on 2 continents. We've got some really interesting backgrounds in people. It's not just the pure finance propeller heads. So, for example, Ollie Campbell in Singapore was a journalist in the emerging markets. He's British, but he also has a Chinese language and literature degree from a Chinese university.
There you go.
Sujaya has degrees in psychology and international relations at both Oxford and Brown University. Very bright young Indian woman who then got involved in starting up an anti-gun NGO in the US. People like Hannah, again, degrees in economics from North America, and then a postgrad in Australia on sustainability, and so really quite multidisciplinary thinkers, and the aim there is really to find someone who's both interested in understanding, for example, some of the key sustainability challenges around consumer goods and plastics, for example, in the environment. But we'll also happily read page 1,500 of a bank's annual report in India to try and pick apart the financial transactions.
Okay.
So it's a privilege to work with a group of people like this because, well, first of all, no matter how clever one might think they are each day, when they write something and put it in front of their colleagues, one of these other people will pick something up that you've missed. But secondly, we're able to leverage off each other's ideas and thoughts and diverse opinions, which is wonderful.
Fantastic.
So that's us.
Okay. And so the strategy as a whole, when did that start?
The
sustainable strategy.
Sure. So the worldwide strategy itself started in December 2012. In the UK, an Australian vehicle started in January 2013. I've been involved in firstly co-managing and now lead managing the strategy from day one. And the Australian vehicle is about $1.2 billion, and the largest strategy, when we include our offshore clients, is about $4.2 billion.
Okay. So obviously you got scope and scale and some really good people spread across the world to really just sort of investigate really thoroughly investment ideas.
Yeah.
Fantastic. So talk to me a little bit about the investment process, particularly around, I know the factors that you really look at are around quality and sustainable companies. So talk a little bit about the investment universe and particularly those two investment analysis features, quality and sustainability, and how that works.
Yeah, sure. For us, it is very much about both. One doesn't come before the other. It's about trying to generate investment ideas by understanding both the sustainable development opportunity as well as the actual quality of the company. And so the process in simple terms is we have the global universe and we can go anywhere with this. So you're actually looking at close to 50,000 listed companies. We obviously don't look at every single one. We don't aim to do that. But what we're aiming to do is find those companies that highlight to us both high quality and great positioning to benefit from sustainability tailwinds. And when we do the work on that, we travel to meet the companies, we road test them. And once they meet our hurdles, we get to a focused list level. And that list is only around about 300 companies. And we're constantly trying to add to that list and take away from it. And they're the ones that we will construct that final portfolio of around 40 to 60 companies that we'll then monitor, aim to own long term. So the aim is around 10-year holdings plus. It's really oscillated anywhere between about 5 to 7 years during the life of the strategy, perhaps reflecting some of the unexpected ups and downs, COVID first of all, and now the situation we see ourselves in. And then obviously when we own these companies to engage with them and nudge them along the path. So to break it out a little bit more, what do we actually mean? So what does quality mean? Because I'm sure you don't meet many managers who will tell you they invest in garbage. But for us, there are three components. And arguably where we're different to many people is probably the first and the third in particular, but aspects of all three. So the first one is quality of management. And what we're looking at is when we look through history of a company and how it's run and the people who have run it, how can we get confidence that those people, that we can trust the people behind the business to manage minority shareholder money well? Because particularly when you step outside of Australia and into economies of different levels of rule of law, for example, different numbers of controlled companies, that is say a founder or a family who owns some or most of the equity, even if it's a listed business. You really want that confidence behind them making decisions in your interest. And so integrity is first and foremost. There are signs everywhere of poor integrity leading to capital destruction. And that could be anything from, the massive fraud from Wirecard recently. There's been a fraud in the US recently around a healthcare testing business as well, which there's now a Netflix series about as well. Okay. But all the way through to the fraud of the solar panel company Hanergy in Hong Kong, And it's not just that out and out fraud where people are fabricating numbers and shareholders lose 80 to 100% of their money. It's little things around siphoning out money through related party transactions. So there might be some sort of asset, whether it be property or a brand that's actually held off the balance sheet by the owner, and they might charge a rent in doing so. Or it might be simply remuneration and the way they channel money out through remuneration, where particularly in the US, there's plenty of companies where executives are taking almost all of annual cash flows out of the company through remuneration. And the way you can account for that can actually hide it quite well. So what we look for is integrity. Are they looking after us? Humility, because humility is super important, particularly for CEOs and people running a business, to be able to learn from mistakes. And you can't run a global business without having mistakes and without the odd almost existential crisis, and that you really need the ability to learn from them. And then competence, obviously, because you want a team of people who run a company really well. And so we ended up in companies often, in fact, about half of the portfolio have some sort of steward who is either a founder or a family member or maybe an operating CEO who is a large shareholder behind that company and also running it. So, for example, we're investing in an Italian company called Diasorin. That was the subject 20 years ago of a buyout between both the manager, CEO at the time, Carla Rossa, and a family, the De Negri family, who made a load of money in the auto sector and actually looked to buy into this diagnostics business and run it. And the way they've built and evolved that company over 20 years has shown the greatest of integrity, because they've made very good decisions in both downturns and in building the company in good times. Really good humility and learning about where they've made mistakes and not, and incredible competence as they've dominated their sphere and produced great returns for shareholders.
Okay.
In a similar way, company like Fortinet, set up by two Chinese brothers, the Xi's, have made really good capital decisions, and they've learned from previous successful businesses what works for them. So history is a good guide there. The second part is quality of franchise. We're looking for what many managers look for as quite traditional things of the ability to deploy capital into a company and generate high returns so that you get this compounding business growth. And there's, very good traditional signals you can look for, such as market share growth, such as the ability to deploy R&D to keep ahead of competition. The ability, and another thing we look at, the ability to position the franchise into something that is quite necessary or responsible or sustainable, and gain some structural growth opportunities from sustainability tailwinds. And so, for example, we're investing in a business called Alphen, which is in the Netherlands. They're a business that's transitioned from electricity integration and networks into electric vehicle charging stations. They've built that part of the franchise through, before electric vehicles were out, buying an old VW Golf about 10, 15 years ago, building their own electric motor, and retrofitting from that. How they think the EV industry will evolve, or would have evolved over time, and they've been able to get on the front foot in that respect. And they've now got a franchise that's rolling out in Europe very quickly. So last year, for example, their electric vehicle charging business grew at 140%. And they're really the key player in Europe who has interoperability across boundaries, both on the hardware and the software side. So a fantastic sign of the ability to compound a business and also provide or benefit from that sustainability tailwind. The third part of quality, again, slightly different to many in the market. We look for really conservative approaches. So what that means is we want a company to profit and grow from the quality of the franchise, what they actually do. We don't want them to have to financially engineer the accounts or the way it's run with their capital to squeeze out that extra bit of juice. And so what that means is we like companies to pay very reasonable amounts of tax. Often in the market, and we'll sit in group meetings with other investors, particularly if it's in America, in New York, where they'll be pushing the company to pay less and less tax, because obviously it's squeezing out more short-term profits for the shareholder. But ultimately, we think that a dollar of earnings with a company paying the right tax rate is far less risky than a dollar of earnings of a company paying very low tax rates.
Okay.
In a similar way, we like to see very conservative accounting. We don't like corner cutting. And the reason for that is we think people running a business who will cut corners on the numbers or be more aggressive in the way they account for things will likely also cut corners elsewhere in times of stress. And when the business is in a period of difficulty, the risk is they cut corners for shareholders as well. And so we're very conscious of that. Again, history for us provides a lot of the information here. And there's that sort of almost regulated in saying around the past is no guide to the future around returns and that type of thing. But we would argue when looking at companies, the past is the key guide to behaviors and how a company will behave and perform and the people in it going forward. So that's the quality piece. There's three bits to it. Yep. We need that bit to work. And then there's the sustainability piece as well. So this is a busy chart, so I'll just quickly explain it to you. Don't get too distracted by it, but it's basically an environmental metric on the side, a social metric on the bottom, the Human Development Index. The dotted line across sort of across here shows that we have one planet of resources. And this is someone we've stolen off the Global Footprint Network we started using back in 2011. And it's a dynamic chart. So economies actually provide greater development for their people and move through that in an arc because they start consuming more resources as they move up to the top right. And then in some cases, unfortunately, these companies can move back this way, mostly because of healthcare, but also education and the like. We need to move to the bottom right, ideally, as a civilization. That is, we want to create social development, human development. We need to allow Nigeria, India, etc., to develop and sort of progress, but we need to do it within the footprint that we have available to us. And so what that means for us is we're looking for companies who understand that brings challenges to our economies. So carbon constraints brings opportunities in terms of poverty alleviation, and with that, the ability to provide necessary and required goods and healthcare and medicines to a whole huge population of people, basic infrastructure services around sanitation, electricity, housing, the building of financial systems, fair financial systems, equitable insurance, consumer goods, firstly in basics down around this level, which is around soap, shampoo, detergent, and then moving up into even things like microfinance and microinsurance. So we are looking for companies that can both contribute to this progression and this tailwind through sustainable economic development, and also profit at the same time, because we're not talking about non-profit businesses. Okay. So when we get the two together, we really are then in that sweet spot for us of both quality companies and sustainable companies, and we pull together the portfolio from there. Okay.
So that's very interesting. Thank you, Nick. So from the point of view of where, on this slide here, so what do you think are the main, what distinguishes you from other sustainable developments? Because sustainability means different things to different people. So yeah. What's sort of unique about the way that you do things? Obviously a lot to do with what your slides that you've had the last couple of slides, but anything, you can sort of elaborate on that?
Yeah, sure. So the big thing is we're looking at what is the purpose and what is the company actually doing with their goods and services, and where, some of our peers are also doing that, but the reality is the bulk of the market is still looking at ESG, and ESG is very much, so environmental social governance, it's very much operational footprint focused still. And the evidence of that is that if you look at some of the big indices out there, for example, you've had an index in the UK, which is an ESG index that has had British and American tobacco in its top 5 constituents for a decade. And that's obviously looking at it saying, well, the operational equipment is really efficient. They probably use very little water and perhaps the most efficient use of paper and maybe even circulation of chemical use and the like. But the reality is the product kills people. In the same way you see that with Coke and Pepsi, which ultimately are sugar pushers, but very, very good operationally. So very water efficient manufacturing facilities. And then even most recently, as recently as last month, the S&P 500 ESG index, removed Tesla from the index, which is electric vehicles, batteries particularly, and replaced it with JP Morgan, which is the largest financier of fossil fuels on the planet. And so I think there's still the bulk of those investing in sustainability are still much more focused on, okay, how does it look from the ESG, the operational footprint? And unsurprisingly, those companies in the dirtiest industries have had to move first, and as a result tend to do quite well, and also have the big marketing teams that fill in the surveys to provide that information. But what we're doing is we're stepping back and saying, well, no, what sustainability solution is the company solving for or contributing to? How is the management team or the stewards behind the team focusing in on the sustainability journey of the business? How we also do look at some of the operational footprint issues as well, and that whole picture is still, really there's potentially a handful of us and our peers doing that side of things at the moment.
Okay, interesting. The British American Tobacco one is sort of surprises me there.
Yeah, there's also, British Aerospace were up there for a long time too, and obviously what they sell is weapons, which is an interesting one. But it just shows if you can answer a survey quite well and you have environmental management systems in your factories and good HR policies, then you can actually get high scores.
Okay. So let's drill down into the portfolio, some stock specific, because other people will be really interested. You mentioned a few already, but I think people will be interested in the type of stocks. And I think, as you and I were talking about earlier, a lot of those names people haven't heard of before, given given the universe that you invest in. But talk about a little bit some of the key positions in the funds, some that have done well, some that probably haven't done as well, and some of the new positions in the portfolio, as well as maybe some that you've actually you've got rid of over the last little while.
I thought I'd just talk to some of our companies rather than put a slide up about them.
No, fair enough. It's a better way of doing it, I think.
So, one thing that's done pretty well with time recently that I mentioned around the franchise quality is Alphen, that I thought I'd pick up on. And so this is a business that's listed in the Netherlands. It was for 80 years working on transformer substations and has really successfully transitioned into more of an end-to-end renewable integrated business. So smart grids, electric vehicle charging, energy storage systems. And so what they've done is spot the opportunity early on in terms of building charging stations throughout Europe. And particularly, this isn't about posts in petrol stations that people can plug in for 5 minutes. It's recognizing how people live in their locality, which is if you're in Amsterdam in a multi-res building, you're not charging in a garage, you're charging on the street, or you're charging at your workplace at the local industrial estate or commercial estate where your car will be parked during the day. And so a lot of those slow charging systems has been really strong for them. They're also now moving into interesting battery systems as well. So, for example, they just last month signed up to provide a large energy storage system in Finland linked into a wind farm. And they've also got some interesting technology coming through around basically flexibility to provide what they call a black start. And so this means that if there's a power outage or there's some sort of intermittency around the wind power system, the storage system itself provides the ability to sort of reboot and recharge the system and maintain that sort of grid continuity, so you don't get the same grid failure that some places are facing. And this is obviously a key part in getting renewable energy built out more broadly across the economy. So that's been great. I mentioned before the battery, the electric vehicle charging is growing up over 100%. The company as a whole in the first quarter of this year grew at 77%. And so it's really in a very sweet spot. So that's done very well for us this year. It is very expensively valued. We've taken some profit from that with that in mind, but it's one that we'd like to hope in 10 years' time is still quite dominant in Europe. Of course, there's a risk one of the big oil majors might buy them along the way, but it seems like a very solid long-term business. Another key holding that's really struggled for us and we've lost money in this year, unfortunately, is Natura. This is a Brazilian listed personal care business. It's predominantly in Latin America, but now growing over the last 3 or 4 years through acquisition globally. So brands you may have heard of include Aesop, which was an Australian business that we bought about 4 or 5 years ago. That's a bit more of a premium end business that they have. Natura is their main business in Latin America. Then about 3 years ago, they bought another business you've probably heard of called The Body Shop. And then more recently, they've bought Avon. And so it's an interesting business. It's got 3 co-founders that own about 40% of the company, have founded it about 40 odd years ago. They're still heavily involved in the business. Very strong sustainability ethos. They drove the company to become the world's first publicly listed B Corporation, so benefit corporation, which means that they're legally committed to driving positive change in both society and the environment. And we've seen that flow through to some really innovative practices around things like packaging, things like fair treatment of staff, and some interesting ways of protecting biodiversity around their sourcing as well. So most of their products are derived from natural ingredients and often from their locality, again, in the Amazon basin. And they've been doing this for decades and now have established relationships with over 5,000 families and small farmers. And they've been providing above market pricing in order for those small farmers to try and protect the local biodiversity. So the way they kind of talk about it is defining fair prices in jointly with the local community and through participative methodologies in coming to those prices as well. And so that's they report that they believe they've helped conserve about 1.8 million hectares in the Amazon rainforest as a result of those practices. And so that's one that has been incredibly painful this year, and that's because of the recession that hit Brazil and the very high inflation in some other Latin American countries, but one that long term we think are some very solid brands worth owning.
So one that we've taken. You still hold a position. You still hold a reasonable position in Natura.
Yeah, so we're up. Well, just below 2% of the portfolio, about 1.8, 1.9, depending on the day. It's fallen quite sharply. And it's a case of it's one that we're going to be quite patient with because the combination of the economic instability in their key markets has hit them at the same time. They're still trying to absorb Avon particularly. And so it's interesting because this is one where the market is very much pricing it, both Avon and the Body Shop at zero. So the market cap, the size of this company now is smaller than before they bought Avon and the Body Shop. And so the market's sort of assuming those franchises will fail, which we think is quite extraordinary because the team, the 3 founders behind this have got track record for decades of building fantastic personal care brands. And things like the Body Shop have been neglected in their previous home. And so, we think there's a great opportunity, but it takes time. This is where, you really have to be a long-term investor to wait out and understand there's an evolution occurring in the company. One that we removed recently, and I thought I'd highlight this because it's interesting because of dealing with people running companies, is a company called Massimo. US listed, was set up by a very bright young guy from Iran who moved to America as an immigrant in his late teens, I think, went to universities, became an engineer, and developed a patient monitoring medical device that does basically measures the blood oxygen in your system. So you get a little clip on your finger. It basically developed those. I was also in a patent fight with Apple because they claim they developed the same technology that you see on an Apple Watch. But but it's a business we've only owned for a short time. So Joe Chiani is the founder. He owns about 10% of the business. He's the boss. And as a business we only owned for a short period of time, we liked the opportunity for them because they were quite dominant in the surgical setting, in hospitals. Clearly had a technological lead, and we're investing a lot in R&D. And it is really interesting example of what can go on quite a lot out there, which is it appears he's embarked on a bit of a vanity project where out of nowhere this year he's acquired a company called Sound United, which will be about 40% of the sales of the new company. So it's a fairly sizable acquisition. And that's a consumer technology company around premium audio systems and an home entertainment brand. So he's gone from very specific high-tech patient monitoring medical devices, which has interesting, huge trust barriers to entry around surgeons or physicians being comfortable with the product, proving that you don't have product recalls, getting the distribution networks right, getting reimbursements from medical systems right, and everything else. And he's gone very left field into home entertainment systems, which is highly competitive, lower margin, much more product release cycle happening, a fashion sense to it, a bit of a trend sense as well. And it makes no sense. It's a very strange acquisition, and it feels like he's doing this because it's something he's into. And there's some interviews where he talks about being interested in home entertainment and music and all this type of thing. And it just didn't sit quite right to us. And so we felt we should exit. Unfortunately, we made a loss because, like us, the market didn't appreciate his acquisition, and it dropped like a stone. So that was disappointing, but we felt best to leave it it seemed very confusing where they were going. Just lastly, one we've added to, and so that was a small, one good thing I should say is it's good to make mistakes on small holdings. That was a small holding, thankfully. One we've added to that we've built up a bit that I'll just sort of finish on is a business called Watsco, which is a US distribution business involved in what's called HVAC, which is heating, ventilation, aircon. And as many people know, it's a huge part of the energy budget for buildings, whether it's residential or non-residential. It's a product or service really that's increasingly being demanded and will increasingly be demanded in the emerging markets. And it's one that needs to be done as efficiently as possible because of that drain on energy systems, but also the contribution to climate change. And so that's one we've moved into. It's a business that has historically been a trusted platform of distribution from the installers and tradespeople that install the equipment. They're agnostic in terms of the brands they sell, and so they're seen as a very useful one-stop shop. It's also a business that's actually quite local and regional. So installers will travel to their local branches, and so throughout the US they've got a few hundred facilities that are sort of quite widespread, which much of the competition is not. And they don't then have to take the technology sort of bet on who's out in front. But there is definitely a very strong trend here in terms of contribution to energy efficiency, reducing cost, and reducing carbon emissions. Because obviously, whether it's in the residential environment or certainly in the corporate industrial environment, the commitment to either net zero carbon targets or certainly lowering carbon emissions is very, very strong universally, particularly in the developed world, but also in the developing world too. So that's a new one. And so what you'll see across those four names I've picked out is it's quite possible you haven't heard any of those, maybe some of the Natura brands, but you might not know any of those companies. It's spread across a range of countries, developed and developing world. And that's pretty typical of how our portfolio looks. There's none of the big fangs, none of the mega cap companies. It's much more of those small, medium-sized ones that are just doing really well behind the scenes.
Okay, that's interesting, Nick. Thank you. One of the things you've spoken to us about in the past, I know when we've caught up and you've presented to the team here, is that around company visits and how important they are and to get a feel of the company. So just want to know a little bit about that and how that process has worked and anything, any recent engagements worth mentioning.
Yeah, sure. So that's restarted again. We've had trips into the US, into India, and into parts of Western Europe in the last couple of months. There's a couple of engagements that have come off the back of that discussions we're having with companies now that might be worth highlighting. And it's so important to us to meet companies because it's important for all investors to meet companies, obviously, but when we do travel, we try to meet the company. We meet some of their neighbours around, other companies around them. We try and meet with some NGOs locally, some journalists locally, people who have their finger on the pulse a bit locally and get a feel for it. And it can lead to engagement conversations around how to improve certain practices. And so there's one I thought is worth mentioning. I'll just share my screen again, so just bear with me very quickly, which is around an issue called conflict minerals. And so hang on a second, hopefully you can see this. So conflict minerals are minerals that, so tin, tungsten, tantalum, gold, cobalt are the main ones. If you own a smartphone, you have them. If you own a laptop, you have them. They're in everything, basically. And unfortunately, the way things have emerged through time is that they tend now to come from the DRC, Democratic Republic of Congo, and no longer from places like Australia and Canada. And unfortunately, as this has been a conflict zone for a long time, and I remember at school reading Heart of Darkness by Joseph Conrad, which is the place seemingly hasn't changed a lot for over a century, but it's an area of military conflict. Many of the mines are run by warlords, and like many commodity supply chains where there are sort of particularly coming from emerging markets, there's real difficulty around traceability. So whether you're looking at palm oil, cocoa, chocolate, cocoa, coffee, minerals like this, there's normally a point in the chain where you get a blending process, and so in this case, it's often in that smelting refinery point where you lose the provenance of the materials. So it gets blended in and you have no idea where it's come from. Yet a large proportion of these minerals are coming from areas that are involving enslaved labor and often overseen by military. Obviously, this is a bigger and bigger issue around modern slavery. However, this is something that has the added complication of military conflict. And it's something that the developed world is consuming quite heavily and companies seemingly don't do a lot about. So under the Dodd-Frank Act in the US listed companies have to report on it, but it's become very boilerplate, very little detail. So what we did is we thought, okay, it's a systemic issue that we have some exposure to. So we own a company called Hoya, which is primarily an eyeglass business. However, they do have some technology that goes into semiconductors, into computer chips, and then similarly Texas Instruments with their computer chips as well. So we thought it's a systemic issue. We needed to try and nudge companies to improve what they're doing because it's both a sustainability risk as well as an investment risk. And so we went to the Principles for Responsible Investment, which is a big industry association for investors. We got some third-party research done to flesh out a little more detail than we were able to get on the issue. We put that forward to investors, and with the aim to engage, and we got $6.6 trillion of investors behind us to engage with these companies on the issue. So we've now written to the key players in the value chain. We've had meetings, 1 or 2 meetings with them all. We've generally found that companies are almost sort of pushing the responsibility for it onto a local industry called the RMI, which is the Responsible Minerals Initiative. which is actually not about conflict minerals. It actually covers a whole load of industries.
Okay.
And there's an absence of proper auditing. There's the inability to find transparency in the supply chain. There's no chain of custody. There's no pushing for standards. There's no trying to get down to understand what the barriers to improvement are. And so this is something we're likely to be discussing with these companies over the next few years. It will be slow going. It may be that progress in 5 years' time is that the big computer majors and telco majors have actually committed to properly trying to audit and work out what's going on. We're not going to be able to dramatically solve this problem or turn the industry around. But it feels like it's just a core systemic human rights issue that the IT and telco hardware side of our world is conveniently ignoring. And that is both as I said, a sustainability and investment risk. So it's something we'll keep plugging away at and seeing where we get to.
Yeah, fascinating, Nick. I think, we all can't do with all our phones and laptops, but we don't realize exactly where a lot of that, that material comes from. And obviously, picture tells 1,000 words, really.
Yeah. And we all know, and we all have these assumptions about the people in China working very long hours, being underpaid in poor conditions, putting together the pieces and concerns about that. But it's actually so much more and further down the chain.
Okay. Can we explore a little bit more that around sustainability, and can you give us examples of companies that make a meaningful contribution to sustainable solutions, in different areas, like you mentioned here in human development, water, and the like?
Yeah, sure. So we tried to look at around the human development side. We've taken Amartya Sen's concept around development as freedom and lifting people out of poverty, and come up with sort of broken the economy up into these different groups that we look to see companies contributing to, and how that actually plays out then is some examples here on the screen. So, I mean, I've mentioned to you Natura. Christian Hansen's a really interesting one, particularly in the agricultural industry. So this is a biology business up in Denmark. Actually, the steward there, or the key shareholder there, is actually a foundation. And a lot of their work is around enabling certainly small farmers, particularly in the dairy or the corn or the wheat industry, to significantly reduce their pesticide use and use alternatives around enzymes and cultures that can trigger the same processes in the agricultural setting, improve soil health, and improve the outcome for smaller farmers. In a similar way, saying in the water side of things, A.O. Smith is a business that's primarily in quite efficient hot water systems. They're the leader in providing those in China, so particularly in the tier 2, tier 3 cities, providing people with hot water, access to consistent hot water. They're now moving into India with water filtration devices. And so they're providing the ability for ongoing clean water, access to clean water for people. Spirax Sarco, a different side of the water equation around water efficiency in the industrial setting. So Spirax is a UK listed business that's involved in factory automation in particular, and really using steam processing as both a water and energy efficiency measure for moving things around warehouse and factory settings and manufacturing settings. On the side of transport, we've got several companies that flow through to electric vehicles, none of the actual what are called OEMs or big brands, but certainly those in the supply chain in electric vehicles. But in this case, there's companies like Halma, for example, which is very much behind the technology around moving or efficient operation of electric vehicles and how they are actually put together. We're investing in companies like Infineon Technology as well, which is around power management semiconductors for electric vehicles, and also autonomous vehicles increasingly through time, as all of these transport systems need greater electrification and digitization as well going forward. And then in the energy side of things, I mean, energy is really interesting because it's not just the pure renewables, obviously. So we don't actually own any wind farm businesses. We've got Alphen with the electric vehicle charging, but
Yeah.
it's other areas that we find quite interesting. So, I mean, Nordson, for example, just makes some of the packaging equipment. And by packaging, I don't mean a cardboard box, but the packaging equipment around solar panel construction. Nemetschek's is a fantastic software business listed in Germany, set up by Dr. Nemetschek, who was an engineer, professor at a university. And his software is very much in both the development and the operation of large-scale buildings. And so obviously buildings are accounting for around 39% of global emissions. So this is a key area we need to bring down carbon emissions. But the beauty of the technology here is that increasingly in countries, and it's not just developed, it's developing as well, particularly in Asia, there are regulatory requirements so that if you're building large-scale precinct developments, you actually need to run what's called a digital twin of the development first. And that's what this software does. So they'll run a complete digital version of the actual process of bringing all of the materials into site, putting it up, removing the waste, then operating the site. And they'll see where they can make greater efficiencies, where it makes more sense around energy management of the actual building. Do you want to install tri-generation? How do you run the systems to ensure lowest emissions and lowest construction impact? And so that's a fantastic sort of assistance in energy. And I mean, if you sort of break it down further, I've just got a couple of slides here that explain in a bit more detail the range of, I guess, areas where we're able to find fantastic tailwinds in contributing to this sustainable economic development, but also profiting. So, I mean, bioMérieux, a fantastic French business that's actually core role is around microbial resistance in medicines and trying to deal with that and look for the path forward for healthcare post there's so many antibiotics out there, but so how to deal with that and how to look for alternatives. But it also has an application around microorganisms in water and agriculture and food. Companies like Spectrus, again, fantastic business, particularly in the food and agriculture setting, around both soil and water health. And then also on the healthcare and hygiene side around development. We own some companies that are making fantastic impact for billions of people. So Hoyer is is either the number 1 or 2 market share, depending on the country, throughout Asia in providing vision correction. So that's everything from basic lenses through to surgical lenses. Okay. And the requirement to allow people to have access to this is still massive. There's still, WHO estimates there's still over 2 billion people who have no access to vision correction, which could literally be access to glasses to read. And they're very well positioned for that. Unicharm is also fantastic, really bringing feminine hygiene products into countries like India, Myanmar for the first time. They have a very large nappy business in Japan. They sell more adult nappies than baby nappies. Very large adult nappy industry there, and one increasingly an issue for the elderly throughout the developed world particularly. And so the impact of that company particularly, I mean, in another economy, it's not there on the slide, but in Indonesia, they're the leader in sanitary products for women in Indonesia. To enable them to remain in the workforce, to remain in education, has massive social ramifications for those economies. So that's some of the sort of companies that we're invested in throughout the portfolio.
It's fascinating. You talk with a lot of passion about the companies that you're invested in, which from our point of view, having a fund manager that really finds this stuff really interesting and has a passion for it's really, really important. So thank you for that. It was really great to deep dive into some of these companies. We're at the last part now. Just about 50 minutes have gone already. I just want to talk a little bit about more, the macro picture from this point onwards. It's been a damn hard investment environment to really to invest in, particularly since the beginning of the year. And I'm interested to know a little bit about what challenges you've found over particularly the last 6 months. We're in an environment of inflation, high inflation, rising interest rates. So have you sort of tried to manage the portfolio? What effect has that had on the portfolio? And then obviously just to wind up with a few things around particular areas or areas and the like that you're sort of exploring for the future. So that's probably the sort of the macro picture.
Yeah, sure. So I thought I'd put this chart up to start with, which is showing, and it has been an incredibly difficult year for anyone involved in markets. I thought this slide was interesting, and I mean, hopefully you can read it. But I mean, it's not that important which sectors these are. But this is the year-to-date performance if you break out the global index of sector-based performance, and what it tells you is that energy has provided all of the returns. And another way to look at that is if you haven't been involved in energy, it's been impossible to keep up, and you've performed poorly. And that's happened to us, unfortunately, over the 6 months. Hopefully that's just a short-term thing. However, this is what's played out. Why has this played out? Well, I mean, first of all, the end of a 35-year period of falling prices and falling interest rates, and that turning around and very rapid inflation. Secondly, geopolitical crisis and the war in the Ukraine, which has massively increased the price of energy, but also food prices, although we're quite concerned about where food prices go to next year because there's a significant delay around food prices. And that's because it's not only what you've probably read about with the Ukraine and Russia providing a lot of output, but also Russia controls a lot of the fertilizer inputs too. And then also we've been in an environment more recently where, throughout that period, real wages haven't kept up anywhere with inflation. And now more recently, we're starting to see consumers hurting, particularly in the US, and some large US retailers have come out with results in the last month or so where they've significantly disappointed and come out saying they're significantly overstocked with inventory. And so it has been a very difficult environment to operate in where everything other than energy has collapsed, because just to spell out the obvious, what energy means in the global stock market is fossil fuels effectively.
Yeah.
There are some pure renewable companies like a Vestas, which makes wind turbines. Unfortunately, in cases like that, they actually got bid up quite heavily in 21 off the back of a desire, particularly in Europe, to build back greener out of COVID. And so they haven't managed to hold up well either. So energy is an area we very much struggle to invest in. Utilities often difficult for us as well. Many utilities in the developed world are highly indebted and also funded by very large pension liabilities.
So what do you mean by utilities exactly, Nick?
Sorry?
What do you mean exactly by utilities? Exactly, what do you mean by that?
So an obligation. So rather than a pension fund owning, what do I mean by utilities?
Yeah, utilities, just a little bit.
So your water energy providers, energy generators, water providers and the like, which are listed in many economies.
Yeah.
Probably less so in Australia. But they tend to be highly indebted, so don't really meet our financial quality test often.
Yeah.
And so we tend to be in a lot of those ones with the green bars going the wrong direction, unfortunately, which has made it quite tough. So what do we do, and what have we been doing? Well, we continue to invest in companies that we think provide some defensive resilience to the portfolio, and by that we mean franchises that are as well as possible in control of their own business. And so not so much the commodity cyclical style, but ones that are a bit more recurring, don't get turned off in the economy. So, everything from a telco business in Finland, where, Finland is the most advanced telecommunications country in the world, the highest data consumption in the world, the furthest down the 5G path, a very organised marketplace, and one that doesn't seem to shift too much, through to consumer names selling basics like soap and sun cream, like Beiersdorf.
Yeah.
And so shampoo, soap, sun cream, people tend not to trade down too much. Through to opportunities where there is a slightly different cycle happening. So we own 2 Indian banks, which we think are of the highest integrity and have shown through historic cycles to perform very well. So HDFC and Kotak are 2 banks we own there. And India went through a very soft credit cycle, really between about 2015 to 2020. Obviously, COVID things have been suppressed. They're now coming through into what is actually should be a healthy and strong credit cycle, quite different to many other places. And so the banks there are now starting to show really good returns, very good asset quality, and we think an opportunity there as well. So the good news is, even though many of our companies are turning left in terms of performance has been poor,
Yep.
their actual performance as companies has been brilliant.
Okay.
And so many of our companies are hitting record sales, record cash flow generation. The orders coming through from what they can see look positive, but there's this gloom over the market. There's the change in interest rates and people starting to look at the alternative opportunity and where to put money. And so capital has come out of those companies, but so many of them are actually performing just fine themselves. And we think as long as we maintain that approach to defensive, resilient, recurring, sustainable companies, the capital will eventually move back into those when we get to a point where energy can no longer keep going up, because ultimately it starts hitting both businesses and consumers, and interest rates can no longer go up because, again, to state the obvious, the reason interest rates go up is to destroy capital investment by businesses and destroy demand by consumers. That's why we put them up. Yep. And so eventually that works, and the capital should move back into these sectors that tend to be less cyclical and more recurring.
Fascinating. Look, I can't thank you enough for making yourself available. It's always good to hear, as I say, straight from the horse's mouth, the people that actually manage the money on behalf of our clients. I know that all of the fund manager webinars have been really popular. I know you did one this time last year as well too. So
yeah, I think so.
It's been a crazy year, obviously. So look, again, thanks on behalf of all of the team at GFM, as well as all of our clients, Nick. We really appreciate the time that you've made available. No doubt we'll have plenty of questions coming from our clients. All the best, and no doubt we'll talk to you soon, Nick.
Thank you, James, and
right,
thanks, GFM.
All right, then.
Thank you.
Bye-bye.
Bye.